Good evening, everyone, and also all the participants and who's and who of the mutual fund industry. As you know, the mutual fund story in India started in 1963, and UTI was the first mutual fund, and after that, the public sector banks and insurance company, they ventured into this field. In 1993, in 92, SEBI was born, and in 93, one of the regulations which was framed was mutual fund regulations. And for the first time, the door was open for the private mutual fund also. And there is a full level playing field both for the public sector and the private sector. There is no discrimination at all. And today, we see there are a large number of private mutual fund players who are in the industry. And recently, there was a news that even the central government, they have decided that the CPSC, that Central Public Sector Undertaking, they have also been allowed to invest their surplus fund through the private mutual fund. This shows that the government and especially if you see also EPFO, they also decided to invest through ETFs. That means government and all, they have a faith in the mutual fund industry. And the structure which was ushered in 93, as you know, it was a trust structure where there is a sponsor who sets up a mutual fund, and then there is a trustee, and there is an asset management company. The trustee holds the assets on behalf of the unit holders, and there is an agreement by which the asset management company, they manage the assets for the unit holders. That's the structure which has been laid down. The structure is totally bankruptcy remote. That I will come afterwards. The thrust of the regulations, if you see, there are many, if you go through the regulations and the framework which is laid down, is based on 5-6 principles, mainly disclosure and transparency, ease of investment for the mutual fund, and to provide a low-cost vehicle, and risk diversification, liquidity, then prevention of mis-selling, and avoidance of conflict and alignment of incentive. As far as the transparency and disclosure is concerned, the theory is that the sunlight is the best disinfectant. And mutual fund, if you see, is one of the product. If you compare it with the other banking and other, if you take example for the loan and all. In case of mutual fund, there is a daily disclosure of NAV and total expense ratio. And there is also disclosure of monthly portfolio a mutual fund is holding. As far as debt funds are concerned, they have to disclose their portfolio fortnightly, along with the underlying yields of the instruments. Earlier, only they were required to disclose only indicative yield. And they have to also disclose the distribution commissions, which a mutual fund is giving to sell their product. Then there is also disclosure regarding the remuneration of the executive, KMPs. And they are sitting here, and they have to justify the money they are taking for managing the fund, and whether they are able to beat they are active enough to beat the benchmark which they have to disclose. That is the disclosure of scheme performance. And then they have to also disclose the large unit holding, if anyone is holding more than 25%, and also other, just like complaint, then there are annual and scheme state accounts and other disclosures are there. And there is one more disclosure which I have to make, that whatever I am speaking here, it should not be attributed to SEBI. And as I said, there is a lot of focus on ease of investment. I don't want to go, and I think especially media and others, they have taken a lot of steps which I think retail investors, they are aware of, and that's why we see the number which have swollen. As far as the folios are concerned, the latest figure shows that it is more than 13 crore. And if you see the unique, I think it is across more than 4 crore. The other thrust of the regulation is the fair treatment of the investors. And mutual fund is a product, especially the open-ended, where the investors can come and go anytime. And it compares with even the bank, where you have, especially if you want to withdraw money anytime or want to deposit money anytime. And this we have seen especially in case of COVID, and when the large number of retail investors, they flocked into, if due to some, as you know, during the COVID, there was a lot of activities which were suspended, and many citizens, they did not have alternate money, which just like some employment in case of hospitality or airlines and all. So people, money which was kept in unit mutual funds and all, and there was a redemptions and other thing, and mostly all of the mutual funds, they were able to meet the redemption pressures. Earlier, as far as the NAV was concerned, for withdrawal of money, there was two rules, depending on the size. If it was less than 2 lakhs, they were getting the NAV of the day. And depending on the size of the amount, also there was some differentials. What SEBI did, there is a now uniformity of applicability of NAV. The units are allotted at the closing NAV of the day. The money is credited to the bank account of the scheme, irrespective of the size and time of receipt of such applications. And we have seen, especially during COVID, what happened, there was a large inter-scheme transfer. What was happening actually, the short duration fund, debt schemes, because they were not able to, in some cases, liquidate their illiquid securities. So those things were being transferred to the other long-term or balance fund and all, and there was an inter-scheme transfer. And this was to the detriment of the unit holders of those schemes. Then what SEBI did, then there was a stoppage of this inter-scheme transfer. And now the rule provides that any such transfer has to be done at prevailing market price for quoted instruments on spot basis. And then the transfer should be in conformity with the investment objective of the scheme. And secondly, no inter-scheme transfer if there is any negative market news or rumor about the security or their downgrade. And one more thing which has been introduced, if you know, in case of a debt scheme, if there is any stress, so there may be large redemptions. And then a new concept of swing pricing has been introduced. And in these cases, what happens, the redeeming shareholder has to bear that expense instead of the unit holders who remains in the scheme. Similarly, the mutual funds, they have been given options. We know, especially in case of debt schemes, they may have a portfolio, and some portfolio may not be that liquid. They may not be able to sell. So the option has been given to them. They can segregate that portfolio. Even if those portfolio which has been segregated, even if a investor has exited the scheme, the investor still he has the right to receive proceeds of return of bonds at a later period, even if they have left this fund. And there is a lot of thrust on prudential and diversification of the scheme portfolio. And the whole thrust of the regulation is that the mutual fund shouldn't, because being a trustee and fiduciary, they should not gamble with the money of the investors. And for that purpose, some limit has been laid down. Limit in case of issuer limit, group exposure limit, own group exposure limit, sector exposure limit. As we have seen that sometime during the stress time, especially in the COVID, some sector came into the stress. Actually, what was happening due to COVID, some moratorium was allowed in the repayment of loans and other things. And therefore, the NBFC, they were not able to get their regular repayments from their borrowers. And in turn, they were not able to pay to their investors, from whom they have, who have invested in their bonds, like mutual fund. So what was happening, there was a cascading thing. There was no payment from the borrower, then NBFC in turn was not able to pay to the mutual fund. And there was, a situation was arising where there was a difficulty in some cases in giving redemptions and other. And to take care of such that there is the exposure of the mutual fund is to a particular sector, do not cross a limit, sectoral restrictions has been laid down. As I said earlier, as far as the mutual fund is concerned, you can see the whole portfolio. In case of debt, the instrument where they have invested, and whether that portfolio, how much is consisted of AAA, AA, and others. In cases when there is a redemption pressure, because all open-ended mutual funds are obligated to give and accept redemption request of the unit holders. And for that purposes, the regulations, there is a lot of thrust that there is no asset liability mismatches and the mutual funds are able to meet these obligations. And there is a requirement that all open-ended schemes, they have to keep at least 10% of their portfolio in liquid assets. And the liquid and other fund, they have to maintain at least 20%. And there is also requirement of stress testing and other. And there is a lot of thrust providing for, especially in case of debt, that as we know that debt is not that liquid as far as the equity is concerned. And a platform was made, that is request for quote platform, where the mutual fund and all the institutional investors, they trade. Basically, especially in case of debt, which are mainly the OTC product. And there was no platform where these instruments could be traded. This was all in telephone platform. The A framework was laid down through which SEBI mandated the mutual funds that at least 10% of their portfolio should be traded through this request for quote platform. for debt and for commercial paper, at least 25% in commercial paper through this request for quote platform. Similarly, many other schemes, and the government also announced in the budget that there will be a backstop facility. And provisions for that still has not come into existence, but a lot of work has been done. And this facility will provide for institutional mechanisms for a framework to purchase investment-grade debt securities both in stressed and normal times. And MFI has been mandated to come out with institutions and set up, that is limited purpose clearing corporations, where they will provide facility for trade in the repo in corporate bond market. And one more thrust area of SEBI is that the mutual fund should address all type of risk which they face. And the risk has been divided into, one is scheme levels and one is AMC level. As far as scheme-specific risks are concerned, the mutual fund has to provide and address all liquidity, investment, and credit risk. And in case of AMC, they have to provide internal mechanism and risk management control for operational risk, technology, information security, and cyber risk, reputations and conduct risk, outsourcing risk, sales and distribution risk, financial reporting risk, legal, tax risk, and talent risk. The compliance risks shall be applicable for both investment management activity and business activity of AMC. Actually, we have seen the industry or all, they see compliance as a burden, but we see it is a part of a business, because if there is a proper compliance with all the rules and regulations, and if it is properly addressed, what may happen, we may see that whatever violations which takes place, especially in form of front-running, insider trading, or mis-selling, those can be addressed. And as you know, there is a lot of, especially the mutual fund as a product, we have seen in all type of media, whether it's a social media, whether it is a news, there is always discussions on the mutual fund products. Our main thrust is that there should not be any mis-selling from any quarter. And for that purposes, especially for the mutual fund, for the distributors and AMCs, SEBI has come out with the guidelines that there is a product leveling. The product should be true to level. And one example we can give is that of dividend paying scheme. Actually, earlier, the dividend in some cases were paid also from the capital. And therefore, they have been told to level their scheme properly so that the unit holders know that he's getting dividend whether from the actual investment return or from his capital. And the riskometer has been made dynamic, depending on the portfolio. If there is because there is always, in some cases, turning of portfolio. Depending on the portfolio, the quality of the debt paper may change, the risk may increase. So it has been made dynamic. And then benchmarking of scheme performance to total return index. And one more thrust area is that there should be avoidance of conflict of interest. And for that purposes, one example we have given that the remuneration of the executives and the fund manager should be such that it should not encourage unnecessary risk-taking. And they should also have a taste of their own pudding. And therefore, a rule which has been introduced is that skin in the game. All the designated employees and KMPs, they have to also invest at least 20% of their CTC in the scheme of the mutual fund. And recently, the units of the mutual fund has been included in the definition of security under insider trading. And for that purposes, all the mutual fund AMCs, they have to come out with the internal guidelines where there will be restrictions on the designated employees for trading in the units of the mutual fund. And the mutual fund, especially, they have to lay down the rules, the closing period, opening period, how much they can trade in the units of the mutual fund. And there is a whole regulatory structure which has been laid down for proper supervision of the mutual fund. And it is basically in the three levels. One is through the trustees, who are the first level supervisor of the mutual fund. And the mutual fund itself, they have to generate a compliance test report monthly where they have to submit any exception if there is any violation of any rules and regulations. And that is monitored. Secondly, the mutual fund trustees, they have to come out with half-yearly trustee report, and which are also being analyzed. And SEBI also conducts inspections. There are two levels of inspections. One is on-site inspection, which is done periodically depending on some risk parameters. And there is also online automated inspections. And this is done on daily basis, and depending on the alerts which is reflected, generated, then those are analyzed, and accordingly, if there is any supervisory concerns, those are addressed. These are the basic thrusts of the regulations which I wanted to state. And often there have been, especially after the financial crisis, there was a lot of debate how the mutual fund industry other should be regulated. There one concept came which, especially in the West, they said whether this type of industry is like a shadow banking, in a sense they are lending but they are not subject to the similar requirement as the banks. But as far as India is concerned, we have a distinct framework. One is that the mutual fund in India, they are not allowed to give any assured return or guaranteed return. Everything is subject to market risk. No mutual fund can give a constant NAV. We have seen in case of USA, there was a concept of breaking buck. There was a constant NAV. If in case of money market mutual funds, the all retail, they were given constant NAV. And if it was below that, it was known as a breaking the buck. And the mutual fund was obliged to give that the amount, even if the NAV was below which was assured. So in India, it is all mark to market, and therefore no question of guarantee or constant NAV. And second thing is that in many countries, they are allowed to originate loans. But in India, mutual fund, they invest in the debt papers, and it is different from origination of loan. And one of the important things is that no leverage is allowed. in other jurisdictions, what they do, they borrow money in case of if interest rates are low, they borrow and then they invest and give return on that. But in India, it is not allowed. There is a limited restrictions on borrowing. They can borrow only if there is a redemption pressures and all for temporary purposes. And we have a concept of fair valuations. What happens if there is a paper, debt paper, if they are not able to sell, if there is a downgrade, then the value which it fetches, that will be valued. And suppose a paper which is both held by a bank and also by mutual fund, and it is a secured paper. So, what will happen for valuation in case of banks, they will have some haircut because it is secured. But as far as the mutual fund, it will be fair valuation. It may be zero also. And therefore, the norms are totally mark to market, and the valuations as for the debt papers, there is a detailed guidelines has been laid down. And one more thing, as I said, if there is a run on a bank, take a cooperative and other thing, or any corporate entity, they are subject to IBC and all. But the structure of mutual fund is like that, all assets are held with the custody, a separate custodians. Even if a mutual fund goes bust and all, the fund will be, the security will be held with the custodian, and everyone can see that fund. The portfolio, as I said earlier, that all the portfolio are required to be disclosed. And those portfolio no one can touch because it is held in trust. It is not subject to any bankruptcy because it is not in the balance sheet of any entity, the asset which has been held by the custody. So those, if there is a, due to some reasons, if any scheme is required to be wound up, the money will be paid from that security which is held in trust. With this, I want to end my talk here. I wanted to and thank all of you, and especially I wish that the topic of the summit, that within 5 years it should cross 1 trillion. I wish all you success. Thank you.